template screening session, and this is going to be ultimate session in terms of learning. So be till the end, and I'll also be sharing one gift with all of you. So that is one more motivation to be there, and I'll be sharing at any point of time, right? So just listen carefully, and whenever I'm giving that link, just grab it. And those who don't have the Excel yet, just type not in the comment box, and I'll give you the link where you can download that Excel. This is a free Excel. A lot of people, charge 5,000 rupees, 10,000 rupees for such kind of Excel. But, I've just given it and made it free for everyone. It was a New Year gift. And that is why, we are here to discuss that. So I'm just sending the link on the chat also. And on the below the video also, if you are watching from YouTube, you can find that, right? So I just sent you that link. Just go ahead and download that. You will get an automated email. Just download that and keep it open with you, right? So it's very important to do it side by side so that you understand a lot of concepts and you don't miss out anything. Super. So let's get started with this Excel. And Ratan is asking, any changes made since last time? No, as such, no changes have been made. It's the same template. But what we are going to do is we are going to go deep dive and understand each and every element, because each and every line item put in there has been thoughtfully put there, right? So it has been consolidation of all my experience which I've put in there. So just make sure that you are downloading that and understanding why it is done. And then it will be like mind blowing. You will get an idea why this is created, how this is created, and a lot of thoughts have gone deeper into creating that Excel. Okay. So let's get started with the screen sharing. I'll be sharing the screen, and let me know once it is visible. And hope you have also downloaded the Excel by now. Okay. So let me share the screen now and open this up. Yeah, so this was the streaming URL. And let me also give a disclaimer before even we get started, right? So the disclaimer is this presentation is solely for knowledge and discussion purpose only. So any stock which I upload here or show as examples are only for example. Don't take them as a stock recommendation. Don't go and buy that. It is not at all a stock recommendation. I'll randomly, open up some of the companies and show you what exactly it means, right? So it is more to understand why rather than what. Okay, so we'll go deeper into understanding the concepts rather than taking this as a any kind of recommendation. Do your own research and due diligence. Again, if you like my method, you can use it. If you think it's not worth it, you can ignore it. Okay, so all of us as an investor have different ways to analyze stocks. Something works for us, something doesn't work for us. So if you think it's bullshit, it doesn't work, it's fine. I'm totally okay with that. So I'm here to share whatever I know, whatever I've learned for last 10-15 years. But if you think it's not worth for you, it's okay, it's perfectly fine. And I'm not liable for any claim arising for the data, because the data is coming from external source. Even I don't have any affiliation with screener.in. It is just that they are providing this free Excel for retail investors, and I thought it will be beneficial to create something, a template which can do more insightful analysis based on that, right? So that is the standard disclaimer. All the views are personal, doesn't represent views of anybody else. And let's get started with that note. Yeah, ready for learning? Just type RTL, ready to learn, and we'll keep it interactive. So guys, whether you are watching from Zoom, whether you are watching from YouTube, just make sure you are interactive and just put comments, and that will make me understand whether you are watching it properly, you are getting it or not. So just keep it free flowing. Just keep your comments coming, and I'll know that you are getting it or not. Okay. So the first thing you need to do when you have downloaded this Excel is this. Okay. So you have to copy this link. Okay. Just copy this link in the second tab. If you have already done it, it's fine. Just in case you haven't done it, I'll show you quickly how to go about it, right? So I'm just pasting this link over here, and I'm doing this. Okay. So this is the first step. Everybody clear so far? So this is the first step, very, very simple step, but very critical. Okay. So make sure you go to this link and you will get this option to choose the file. So choose the file over here and go to your version where you have saved your file. So say for example, I have saved this file over here. So I've just uploaded this and then click on upload button. As soon as we do this, the template is ready. So it says Excel customization saved. So your job is done. That's it. So now every time when you use screener.in, okay, so this is a website for people who don't know this website. This is a website created by Indian founders, Mittal brothers, Ayush and Pratyush Mittal. They are good friend and well-wishers. And they have created this amazing tool for retail people in India. And, this Excel template, they have created a free feature, so you don't need to pay for this. You just need to sign up on screener.in and it will start working. Okay. Again, I don't have any vested interest, disclaimer. Neither I have anything to do with Screener as such in a personal capacity, but I find this very, very amazing tool to use. So that's the reason I'm telling this. Okay. So then the task is very easy. You need to do a sign up for the first time. If you are not doing sign up, you might not reach to this step. So if you have not done that, just do that. But you have to just create a free sign up and it should start working for you. So once you do that, right, you need to just type any name of company. Say for example, this is one of my favorite companies, which I've been invested since many number of years. So just type the name of the company and you will see this button. Okay. So you'll see the button called as export to Excel, and you should click on this button, and that's it. So once you click on this button, all the data which is out there in this entire Excel template over here, and some of the backend data will also start flowing into your Excel. So let's see, once it opens, we'll go to it. Let me see where it has gone. Just let me stop sharing and see if you have any questions so far. I'm seeing some pop-ups in terms of questions. Okay. Okay. So first question is just miss the initial conversation. Yeah. So go to the steps. Okay. So let me just quickly repeat for the benefit of people who just joined. And disclaimer again, I'll not be repeating the same thing, but just do this simple steps. Okay. So go to the instructions tab, go to this particular tab, and copy this link www.screener.in/excel, and then just copy paste that link over here like this. Okay. And then choose the file, the Excel file which I have given. If you don't have it, just go to this path, technofunda.co/excel. And if you are watching from YouTube, you'll also find over there, right? So just type technofunda.co/excel, and the Excel file, you can download it. Okay. So that's how you need to upload that Excel file. Once you upload, it will say Excel customization save. And then straight away go to any company which you want to analyze. I'm just taking Vinati Organics as an example, no stock recommendation. Uh, it's part of my portfolio, but yeah, no recommendation at this price or nothing to do with this, right? So it is just for example. And what you need to do once you come to this is click on export to Excel. So you need to just click on export to Excel and the magic will begin. You will get the Excel file download. And this is the file which I have gotten just fresh right now. When you download the file, most of the times you will get this message, protected view, and you need to click on enable editing. Okay. If you don't click it, the data will not flow. You will say, the Excel is blank and this template is not working, but that's not the case. It's just that uh, for data to flow properly, you need your enable Excel to be activated. Okay. With me so far, just type with you in the comment box if you are with me. Let me check on YouTube also whether people are with me. Just give me a second. Yeah, superb. So all of them are with me so far, and let's go to the next steps. Superb. So now it's going to be very, very amazing, and take notes. Okay, take notes because it's going to be awesome. Okay, so this place, once you come, you need to go to overview tab. So click on this first button, go to overview tab, and you will find this particular tab over here. So as soon as you open this tab, once you export the Excel for a particular company, you will find the overview about that company over here. Okay, so you'll find what is the name of the company, what is the current price, the last closing price. You will get a number of shares, market cap, net profit. TTM is basically trailing 12 months. So last 12 months, what company has done, the profits, you will get it. And it will be also generating a price to earning ratio, which most of you use in your investing also. So price to earning ratio is nothing but market cap divided by the net profit. And here we are taking trailing 12 months net profit because that is the latest one. So if you are, say for example, looking right now, so right now it is January, right? So probably the last financials would have come in is for probably December, or even if it is not coming, it will be for September. Now, if you just do a financial year, what will happen is you will do from March to March. So you'll end up going into back in history till March 2020. So it will be March 19 to 20 numbers, which doesn't make sense, right? Because after 9 months, company would have changed. You all know COVID came in and the numbers would have gone here and there. So it doesn't make sense to actually see FY data uh, when you are much ahead in the year. It always makes sense to see the TTM data or trailing 12 months data. So it will trail the data for last 12 months instead of financial year. So that is what we have created. Again, as I said, this Excel is created very, very thoughtfully, keeping in mind all the things which I look in the investing parlance. So is like ultimate template you will find. Okay, and the best thing is it is free. You don't need to pay for this, and you save a lot of money by using this. Okay, so the next thing is TTM operating margin. So operating margin is again very important, and I'll tell you about it once we jump into income statement just next after. But it is just a summary which has been pulled over here. And same way ROAE and ROACE. All these things we'll discuss in detail. So if it is going bouncer, don't worry about it. We'll discuss all of these. Okay. So the first thing that hits when you do the analysis of any company, okay, is income statement. So income statement is one of the most critical thing to watch in a company. Why is it a critical component? Because everybody wants to earn income in some other way, right? So that is the reason it is very critical. And how does it flow? Let's take a small simple example. So say for example, you have a guy who is selling pani puri near your street. I like pani puri, so I just take pani puri or vada pav example most of the times, right? So say for example, you have a guy selling pani puri, and one plate, how much it costs? Say 20 rupees. Okay, say 20 rupees is the pani puri cost, and they sell it for how many customers? Say 100 customers are coming daily. So what is the revenue they get it? So that pani puri wala bhaiya ji is getting 2000 rupees as a revenue. Then of course all aloo and everything is costing them something, right? So all the cost, say 50% is his cost of whatever he is earning. So what will be the cost of goods which is putting into this will be 1000 rupees. So cost of goods sold, this is known as gross profit. Okay, this is known as gross profit. Of course only batata and puri and everything doesn't go in pani puri. You need to have a delivery guy sometime. You also need electricity. You need some rent to pay for the expenses and everything, which is more or less, some portion is fixed cost, some is other cost, variable cost. So whatever is your operating expenses, say 500 rupees of all these will go into expenses from whatever you have earned. So you are left with 500 rupees, which is known as your operating profit. Okay, this is known as operating profit. And then you also, if you have taken loan from somebody, you have interest income. If you have any assets, there is a depreciation. All those things get removed from this, and you come to something known as profit before tax. Before paying tax, what are you left with? And then you of course pay tax to the government, right? And then you are left with the net profit. This is how entire income statement looks like. Very, very simple. Okay. So nothing difficult. Even if you are non-finance, you have never seen this, nothing to worry about. It's like as simple as it can get. Is it easy? Just type easy in the comment box. Yeah. If you found this easy, just type easy in the comment box. Very, very easy. Now, why this is important? Okay. So this is the biggest question. So Sawal 10 crore ka is why this is important and why you should study income statement and how you should study income statement. So that is what this sheet does. Okay. So say for example, you want to get a long-term compounding company, say 10-year compounding, consistent compounding companies. So think of your house. Okay. Think of your house. If you are getting some salary, okay, if you are getting some salary and you are doing some expenses, you have electricity bill, you have bill of your telephone, grocery bill, everything. Can you continuously keep on reducing your expenses? Yes or no? Just type in the comment box. So say you are getting 1,000 rupees electricity bill. You try hard, you switch off your geyser, you do everything you can. You reduced it for till 800 rupees. Can you again reduce it? Okay, suppose you have done more aggressive selling. You can do it till 700. But there is always a limit to it. Okay. So there is always limit to how much you can save in terms of expenses. If you want to long term grow, say today your salary would be 10 lakh rupees per year. If you want to make it 30 lakh, can it just come from uh, saving expenses? No, right? You need to grow from the sales perspective, and if you want to grow for a long period of time, you have to basically grow your salary. If you are doing your business, you have to grow your business, as simple as that. So that is the reason the first parameter which we have put in is very, very critical. Okay. So this is very, very critical. I'm just going to that. Yeah. So it is basically the sales growth. And when you are looking for long term investing, you want to see what is the long term trajectory. If it is a cyclical company, what will happen? 3 years it will give bumper sales growth, then it will again dip. But if you want to get a compounding company, you want to see all these three things, whether it is long term compounder, and even in near term it is compounding. That's the reason 3, 5 and 9 year, all three parameters are kept it. What will happen if you just look at 9 years? What will happen if you just look at 9 years and ignore the near term part? We'll get past winners. जो पहले हीरो थे वो आपको मिलेंगे, right? But you want Gode which can still run. You don't want horses which have tired after the race. Okay. So you want still a running horse when you are investing. So that is the reason you should see the long term growth rate of sales and your 3 years also. So that is one parameter. If sales is not growing, from margin you can only do so much. Okay. So you cannot grow perpetually through your margin. Now, again, second thing which I have put in here is EBITDA, because you want to see the combination of sales growth and what you are doing from expense saving. So some company would be, they are aggressive in, selling, but their expenses are also increasing simultaneously. Then your EBITDA or the operating profit will not grow that much. And ultimately you want to see what is my profit growth, what is the net profit which I am earning. So that is what is most critical item over here. Again, that same thought process is there. 9 years and 3 years, both you should be seeing. That is the reason this has been put in here. Okay. So this is one part you should immediately see as soon as you go into this Excel. Now, second most important parameter is operating profit margin. How much margin you can make in a product. Okay. And what does this denote? This denotes whether you are a very, very efficient player, whether you have a competition or not, and whether you have some competitive advantage built in your business. And let me give you a simple example. So say one pani puri wala, whatever example I gave, he is earning 50% operating profit margin. So whatever raw material he is using, whatever expenses he is doing, even after that he is earning 50% net at an operating profit level. Is it a good business or bad business? It is a good business, right? You don't need much of asset. Ek thela dal diya and you are go up and running, right? So will other competitors or Raju Chacha and other players who are other friends of his will start uh, doing the same business or not? Of course he will do, right? They will think, okay, this is a great business, let me also do it. So they will start and they will cut prices. So that guy is selling 20 rupees and Raju Chacha will sell it at 15 rupees because now he wants to attract customer, and he's even fine with 30% operating margin, right? 100 rupees business you do and 30 rupees you are getting. Awesome business, right? So that is the reason uh, you should focus on operating margins, because when competition will come, they will attack on both pricing front, the sales part, whatever sale amount you are making, and they will also attack on efficiency part, that they will also try to decrease their operating expenses. So that is the reason, just by looking at operating margin, you get to know whether the company is good in terms of competitive advantage or not. And if you find some company more than like 10-12%, generally they will be doing something very, very special. They will have some kind of pricing power. Say that guy is having super pani puri and he has best test in the town. So even if some Raju Chacha is opening nearby, people will still prefer eating pani puri from him. And even if he increases the price, say in future, say he makes 22 rupees, still people will go there. If there is no comparable taste, they will find. So that is, the taste is the competitive advantage of that person who is selling pani puri. Okay. And same way, that guy might be super efficient. He is bargaining his vendors who is selling potato, pani puri, everyone he is bargaining a lot, and he is getting the best pricing. So that is another way which will show that this guy has good pricing power. So that is the reason you should always and always look at operating margin. And even better, if operating margin is increasing, what does it mean? That the product is in good demand, they are able to charge any price they want, so the sales is increasing, and it is increasing much higher than the expenses are increasing. Or it could also mean the raw material prices are decreasing, or it could also mean that that player has become so efficient that their other expenses are decreasing. So all these things, three things, gets captured in operating margin. And if it is in increasing trend, this is what you will see, something like this. And here again, there is a thought process that has gone into it. So if the margin is decreasing, it will become red. If it is increasing, it will become green. It is automated template. So as soon as you change the company, automatically it will change. So it is like automatic formula which are inbuilt with the use of conditional formatting. You don't need to worry about it. So just by glance through, you know that out of 8-9 years, only 1 year their margin dipped. Okay, same way if you look at net profit margin, same thing happened. And you can also, one more thing you can do is, you can see that what happened in 2018. So the question should trigger, why 2018? What such thing that happened that created such fall in the operating margin, net profit margin, and why this growth was slightly tempered in this year? And if you ask why, then go to annual report, con call report, go to credit rating report, you will get your answer. But first thing you should know where to ask why, because a lot of people will do donkey work. They will say, I am a good long term value investor, I will read each and every annual report, 10 years annual report they will read. But at the end of the day, they will not get any insight, because they don't have any questions why to ask, right? So when you have why to ask, that is where you will get much more insights with the same data points in much lesser time. Are you with me? Just type why if you got this point, right? So ask why. Ask why this fluctuation is happening and why this deviation is there. That is where you will start getting answers immediately. Okay, any company for that matter. So if there is a trend which is happening and suddenly there is a dip or change in the trend, you should know that, okay, something is gone wrong over here. And based on that, you will also get a risk profile of that company, that what potential risk is there for the company which has decreased this margin suddenly. And that is where you can form that long term view that, okay, I need to be aware about all these risks. Clear so far? So that is on the income statement. Okay. And one more thing which is very important, which I look into the companies, is what is the kind of debt profile, and whether that company will be able to pay their interest properly or not. So how to look about it is very simple. There is a ratio known as interest coverage ratio. So it is very simple. Say for example, you are a salaried guy. You have 1 lakh rupee salary per month, which is coming into your bank account. Now, out of 1 lakh rupees, what is happening is you are spending in grocery, your day-to-day expenses, your rent, whatever your normal routine expenses are there, and you are left with 60,000 rupees. And suppose you have bought a house which has a EMI of 30,000 rupees. So what does that mean? After all the expenses, whatever you are left with, how much times you have capacity to pay? Two times, right? 30,000 is the outflow of EMI, and you are saving 60,000. So 2x is your interest coverage ratio. So same way for the company, it goes that you need to see sales minus all the operating profit, and go to EBITDA and see what is the interest coverage ratio. And if you click here, you will get the idea. Okay, so whatever you are left with, and how much is the interest, that will give you the idea about interest coverage ratio. So this is all, the formula are there, so you can go through the formula also. Basically it tells that after expenses whether you are able to pay interest. If yes, how many times you have cover of it. So if there are fluctuation in the operating profit, whether you will be able to sustain it or not. Ideally about 2x is generally good. If you are conservative, go for more than 3x also, that is also fine. Okay. And this will again, the higher the better, because the more coverage you have, say you have 30,000 rupees of EMI and you are saving 1,80,000. So your cover is 6 times. So even if COVID kind of situation comes, your salary becomes half, still you are able to pay. So the higher the number is better. And that's why, if it goes higher here, it will become green. If it goes lower, it will become red. As simple as that. And then you have PE ratio for all the year. This will also give you idea whether market is giving revaluation to this kind of company where the earnings growth is there. So you'll get an idea whether it is just the growth is happening through earnings growth, or it is also happening through a PE re-rating mechanism. And one more thing which I do, okay, this is very insightful. Just note it down if you have notepad. So what happens is most of the times, okay, most of the times the market will discount the future earnings very early. Okay, so even before the financial statements comes out, annual report comes out, the results comes out, market are smart enough, most of the times they will discount the future. So what will happen is when this P re-rating is happening, right? So from 15 it has gone to 30 and then 32. In the next year you will see good profit. See the this year, this 3 year it was flat. Okay, this 3 years it was flat, but what happened to PE? It just doubled. And if you are just looking from the fundamental analysis point of view, you will think, yaar, ye to महंगा हो गया, this is so expensive, I should not buy it. But then market is smart, they discount the future. So in fact, in 2019, they are doubling their profits, but the market discounted it well in advance. Here, what happened? The PE actually declined from 32 to 29, and then it declined to 23. And we think as a fundamental investor, कि ये तो यार नीचे चला गया, now सस्ता हो गया, right? But then if you see, there is actually dip in terms of the growth. So here it was almost double, and here it was like almost 10-12%, which is nothing in terms of the growth which this company historically did. And there is always a reason why market does that, right? So that is what you have to think about. And that is why, if you go to even charts, you will see all those kind of trades. So what I generally do is I blend both the things, so I use TechnoFunda investing methods, where I also see what my uh, chart is saying. It is some geeky stuff out there. Just let me remove this first. You will otherwise go crazy. I do a lot of in-depth volume profile analysis and all that, which I did for some companies. But let's see same company. Okay, let's see the same company, and you'll get idea what I'm talking about. So let's create a long-term chart, and this is what you will see. See, from 2018 to 19, there was a sharp run, but now the chart is just waiting for the next move. It is just consolidating for 1.5 year. So here, looking at just the fundamental data, you would have thought I'm entering at a cheaper level, but actually you are not making much money. And here in 2017-18, you might have thought you are getting into an expensive price over here, and then stock is just making 3x in 1.5 year. Getting me? So never just depend on fundamental analysis. It is always important to see through it what market is discounting. If you can read technical analysis charts, even better. Okay. So that is how you should look holistically. Don't just go narrow down by the definition ke sasta p, then it is cheap, expensive, then it is expensive. Just see why it is happening, why market is discounting. Again, same thing, ask why. So this is on the part of income statement. Everybody so far with me? Again, I'll keep on asking. Just type with you in the comment box. Yeah, so everybody with me so far, right? And getting it. Bulbon. Ruben is saying Bulbon. Awesome. So Ruben is watching from YouTube, and a lot of you guys are on YouTube also watching this live. So amazing stuff. Thanks for that. And what we'll do now is go to the balance sheet. Okay, so let's jump into the balance sheet to get a more deeper insight. So let's go to the balance sheet part, and you will understand what to look in the balance sheet. So main thing first I look at is mainly the debt, because if company is having a heavy debt, I generally am wary about it. Okay, and again, this is a personal choice. You can do whatever you are following, but I just want to see what is the kind of debt level. So first thing I see is the debt level, and just standalone debt level is not important. So it is always important to see debt to equity ratio, and this is what I have derived here. So anything below 1 is generally fine. This company is almost debt free in last few years, so there is no question to see this any which ways. But if it is more than 1, I generally get skeptical. Again, it's depending on sector which you choose. Okay, so there is no a hard and fast rule. Again, some sectors are inherently slightly heavy in terms of what they do. Cool. So that is one thing you need to observe. The second thing which the balance sheet gives you an idea is what is the net fixed asset turnover, and you have to again merge it with the turnover, that is sales, and all the formula I've embedded here. So in simple terms, what this particular thing does is it will go to income statement, go to the sales part, and then it will divide it by the fixed asset, the net fixed asset after the cumulative depreciation. Again, if you are finding all these terms very tough, I would say go through some fundamental analysis or financial statement analysis thing. But right now the focus is not to explain the underlying terms, it is more to explain the template. So I'll focus more on what it does and how to interpret rather than explaining financial statement analysis, right? So that is a subject in itself. Probably we'll do some videos later on. I have a couple of basic financial statements videos in my channel also. So if you have not seen them, you can watch them at a later point. But right now the focus is more on Excel thing. Okay. So this basically tells you how more you are squeezing your asset. Okay, so take an example of laptop. So all of us have a laptop, but if I'm say using my laptop 24 hours, say 12 hours I'm using, 12 hours my brother is using. So what will it happen? Whatever output I'm getting, say in terms of laptop, it is intangible output. It's not exactly the sales money, but think like if I use more, I get more money. Think in terms of sales. Then if I'm using it 24 hours, and I'm extracting maximum for my laptop, that is the turnover will be higher. So basically the same asset, I'm squeezing it. Just type squeeze in the comment box, squeeze, right? So you squeeze your fixed asset to maximize your sales. As simple as that. The more you are able to squeeze, the more sales for that asset you are getting. So this ratio is again important, and again this should be looked in the context of a sector. So if you are comparing a FMCG company with a pharma company and you say pharma is squeezing more asset, it will not make sense. So these kind of analysis should be done industry or sector wide, so that you know that, okay, if Ashok Leyland is squeezing 2 times and if Maruti is squeezing 4 times, why Maruti is able to squeeze 4 times? What special they are doing? Are they better in terms of efficiency, or their assets are cheaper, or they are running in shifts? You will get answers. Okay, so you have to again ask Why? Just type why in the comment box, right? So ask why this ratio here it is less, why here it is important. And second thing you should do is in terms of trend, and this applies everywhere across the Excel. So see the trend. If the trend is decreasing, you again ask why this from 2.6 it has gone to 1.5, whether they are not able to sell their goods, or they have put in a new plant which still it is not operational properly and they're running it at a lower capacity, or is it a seasonal business? After every 2 3 years there is a downturn. What is it? That is where you will start getting answers around business model also, right? So here basically what is happening, you have fixed asset which is increasing over here, and here it has jumped up. So probably this fall is not because the revenue is decreasing because of market factors, but it looks like that it is because of the asset which has increased. And you know, sometimes you just deploy a plant and immediately you cannot run 100%, right? It's like when you join a new job, you cannot just go 100% on the first day and deliver all the output. So it's like same in the industry. So they cannot deliver everything you know, immediately you set up the plant. It takes some time. You know, the capacity will slowly increase, they will get some orders, they'll fix the distribution. So lot many things needs to be done when they do a new capex. So you have to, when you ask why, you will start getting question. If you just go blindly 10 years, okay, I've done this analysis, let's see what is the trend of fixed asset for 10 years, you will not get any answers. That is not fundamental analysis, right? So hope this is making sense. Make sense? Just type MS in the comment box and we'll make it fun like this. Okay, so when I tell you, just type the comments and have fun. Okay, learning should be fun. So then next is, you know, inventory days and receivable days. Again, this same thing should be looked in the context of industry as well as trend. Receivable days are basically when you receive your money from customer. So say Raju Chacha is selling pani puri and he's getting money immediately. That means he's having good pricing power. But many people, if they are giving after 1 week or say 10 days, that means, you know, something is wrong. Probably they are facing more competition where somebody is giving, you know, credit for longer days, or, you know, the demand has gone down, or the customers are not having money at that point of time. So a lot of factors goes into seeing the trend of receivable days. Again, you should look at the with the context of the same thing, you know. So here the receivable days are increasing, but it could be probably because they have launched a new product and they are still, you know, making sure how to optimize it. So small jump is fine, but if suddenly it goes up, then you have to be cautious. Third is cash flow statement, which is very important. It is very important. Just note it down. Cash flow statement, most important, along with balance sheet. Very important. Why it is important? Because all the golmaal which people do in the companies, the promoter does, is very easy to catch from cash flow statement, but it is not very easy to catch from income statement. Why? Because there is concept of two things: accrual accounting system and cash accounting system. So say for example, you came to me, right, and I'm say selling pani puri. You came to me and you told, you know, I want 10 pani puri. 10 plates I've given you. You're not paid any money. Still I can write that in my sales and book the income. So it will reflect in my net income that, okay, sold 10 plates pani puri, got 200 rupees, net profit 100 rupees. And now you have gone somewhere, you know, COVID came in and you went somewhere else, and now you settled in a different city. You never came back. So did the cash come to me? Cash has not come to me. So if the cash is not coming to you, that means it will not reflect into the cash flow from operating activities. So this was accrual based, where you just booked the profit based on the sales you made, and cash accounting is where only when you generate the sales and get the cash, you put it there. So anyone who wants to fudge the financial statements, one of the very key way people use it is make false invoice. Ye becha, ye becha, ye becha. And you just write it down your invoice and you say sold 1,000 crore rupees, 500 crore profit. Paisa kuch aaya hi nahi, right? So that is a prominent way people use to siphon money. So it is always important to see ki by net profit is there, how much is coming to your operating activities cash flow. And that is the reason I've created this particular metric. And again, sometime it can have mismatch. So somebody took advance in February and then they are paying cash in April, so it will reflect in the next year. That is fine. There will be fluctuation for 1 or 2 years and the numbers can go up and down for a couple of quarters. That is perfectly fine. But if it happens on a long term period, say 5 years or 10 years, that tells boss kuch to gadbad hai. There is something wrong. That daya thing, right? Daya says kuch to gadbad hai, daya. That is exactly what happens. So you have to see that long term how much money is coming back to you. And that is where you have to see, this is the profit after tax, this is the cash flow from operating activities. At least 80% of your profit should come down as a cash flow from operating activity on a long term basis. And this is where I've done a 10-year total divide by 10-year total. So this figure, if it is greater than 80%, generally it's a fine company. Generally it's okay. Clear why I've put this? Now, second thing, a lot of companies also siphon money through capex. So that is again what you can observe here. And also you need to know whether my company is doing any capex or not. It will reflect here. So here, as soon as you see the trend, you will get to know whether there is a growth happening in the future or not happening in the future. Now, a lot of people say free cash flow is very good metric to see. So let's take an example of Pani Puri wala only, right? 100 rupees he is earning every day. Now he doesn't have any reinvestment opportunity. He's selling today also 100 plates. Tomorrow also he'll sell 100 plates. After 1 year also he's selling 100 plates. After his kid is selling Pani Puri, he is selling 100 plates. And his kid's kid is coming, he is also selling 100 plates. Why? Because he is not reinvesting into growth. So whatever growth would be there, he might get 5%, 7% increase, whatever he is getting. But he's not putting up a branch. He's not extending that to newer city. So only when he will expand, that is where the growth will come. Otherwise, he'll just stand there and whatever number of people are there in that colony and what is the normal number, that is only thing he will get. So still he is generating 100 rupees free cash flow every day. But is it good if you are an investor to see a grandson, son, and that same guy doing the same business, same free cash flow? No. So why capex is important? Because you have to reinvest your cash flow from operating activity to a newer growth area, and it should be done at a good return on capital employed. That is what we will also learn. But you have to basically put money at work so that you can expand and grow your sales. So that is why more than free cash flow, ideally it is good to look first at capex, and if they are able to do at a generous return on capital employed, that is a good thing. Let me again check clear so far. Just type clear in the comment box. And are you finding it amazing? Just type amazing if you are finding it amazing, so that I know you are getting it properly. And this is like next level. Okay. This kind of analysis and study you will not get every day. Okay. Superb. So yeah, Sharad is saying, will you be sharing recording? This is already live on YouTube. Okay, so you can get the YouTube live video from my YouTube channel. Let me check with you. Are you all subscribed to my YouTube channel or not? Not yet. I'll just share the link on the Zoom also, and if you want on the YouTube also. So just bookmark that link if you are not yet subscribed on my YouTube channel. There are tons of videos like this. Go ahead and see them after this session. Okay, so there are tons of such material. In fact, there is one video on TradingView. There is one video by the founders of screener.in itself, which is next level. You should definitely watch that. Okay, so that is on the cash flow. So now let's jump to some of the ratio analysis. And this is very, very important again. So ratio analysis, what I've done is basically I have integrated all the ratios from different tabs. So you have seen income statement tab, there are some ratios. Then there is a balance sheet tab where there were many ratios which were important. And then you have CFO by Pat, which we derived from the cash flow statement. Now, one more important thing which I have is known as DuPont analysis. And this is very, very important, guys. If you have not studied it, I would say definitely study this DuPont statement model. And what it does is it breaks up the return on equity. So, what is return on equity? Return on equity is very simple. Equity is what I put in the business. So, say for example, Pani Puri wala has put that thela and set up the entire thing. So he might have put his money, say 50,000 rupees, and at the end of the year, he's getting say 10,000 rupees as profit. Okay, 10,000 rupees full year he has earned as a profit after putting 50,000 at work. So 50,000 is his equity and 10,000 is his return. So the return on equity will be net profit 10,000 divided by 50,000 rupees of equity which he has put in. So what will be the return on equity? It will be 20%. So this also you have to think in context of what is the cost of capital. So say you have return of 8% in FD, say for example. Okay, so in India you generally used to get, abhi to nahi mil raha itna, but say 8% you are getting return on your FD, fixed income, or even government security, risk free bond. So if you are getting say 8% return there and you are getting return on equity of 5%, will you do that business or not? 5% return on equity. So when you are putting up 50,000 rupees, you are getting 2,500 rupees net profit full year. Whether it will make sense for you to do business or you will put your money in FD. Of course, you will put your money in FD. So that is the context you have to see return on equity. And it is very important कि भाई पैसा जा कहाँ रहा है, right? Because return on equity is net profit. सब कुछ खत्म करके you come to net profit. I have shown you the example in the initial part, and then you divide it by your equity. So the DuPont analysis gives you the breakup of where your money is leaking. It's like you have opened the tap, it is coming from one layer to another layer to another layer, and then it is remaining to you where the money is going. So it basically divides into 5 categories. And this is very, very simple equation. Sometime I'll make a video on DuPont analysis also. But this is very simple. You should obviously just see that model, just Google it later on and see how does it tie up. But basically it will give you the breakup into 5 different buckets, that what is going in tax. It will tell you. So you basically divide net income by PBT. It will tell you tax, my 21% is going. So 1 minus 0.79 is 21%. So tax 0.21 has gone. Now interest, what is my interest burden? That is again 8%. So 0.92, 1 minus 0.92. That will tell you what is the interest burden. Then it will tell you from your margin how much it is coming. So if your margin is high, obviously your profit will be high. Then it will tell you how much it is coming from your asset turnover, how much you are squeezing your assets, right? And it will tell you the multiplier over there, that for a fixed total assets, how much sales you have generated. And then it will be equity multiplier. See, your ROE can also increase by taking more debt. So say instead of 50,000, you just put in 10,000 rupees, and 40,000 you got it from your friend Ramu Kaka. So 40,000 he has given and 10,000 you have gotten. And after interest and everything, if you are left with 2,000 rupees, then what is your return on equity? 20% again, right? 2,000 divided by 10,000. But has the business improved? No. The business is same. You are getting earlier 2,500 rupees. What has changed? You have taken so much of debt. And that is the reason your return on equity is getting higher. So this will also tell you whether you are highly leveraged or not. So if this multiplier goes very high, then you have to again think about it, why this is happening. Okay. So that is on equity multiplier. So the more you debt you take, your total asset as a proportion of shareholders equity will bulge, because you are taking a lot more other assets from your debt funding. But is it good? It's not good, because that will increase the risk in your business. When cycle will go down, when COVID will come, Ramu Kaka will ask for the interest, but your business will not be doing good. So you will make losses also sometimes. Clear so far with me? How many of you had a bulb on moment? Just type bulb on. You are learning a lot of things, never thought about it. Your mind just sparked. Just type bulb on in the comment box. Yes. So this is how you should look business and analyze the companies. Now, do you want to do some more, you know, Sherlock Holmes kind of analysis? Then just type yes in the comment box. What we'll do now is we'll do some companies which are doubtful financials. We'll try to find, if there is anything wrong or not. So just type the name of the company which you want to see. Just give me some names and we'll do it live. Again, no recommendation. Whatever we will be discussing, it will be just for knowledge purpose. But we'll try to do some analysis. Okay. So let's take manpasand. Okay, manpasand is everybody's pasand. So let's take manpasand and do this same analysis. Okay, so I'll now share the screen again. Let's have some fun. Yeah, so let's take manpasand beverages. Manpasand beverages, export to Excel. It will take some time to open. Hopefully it will open soon. I have so many devices which are connected, so it takes bit while, but yes, the magic is here. So let's take manpasand overview. Oops. Okay, I've gone to a different tab. Yeah, this is the one. So this is manpasand beverages, current price 6 rupees, number of shares 11.4, market cap 67, and net profit minus. So it's doing losses. So just from the glance, let's repeat the steps what we discussed. Just from this glance through, will you invest in this company or not long term? The answer automatically you get it right, whether to invest in these kind of companies or not. So that everybody now knows, but any which ways you know that this is not worth doing it. Now here the margins were going down 2016 to 18. So this was the time to ask why this is happening. Again, the interest coverage and everything was fine overall, because they went for IPO. Probably they cleaned up the mess beforehand. Let's see on balance sheet what happened. Let's see balance sheet, whether the borrowings was increasing. Here it went debt free and suddenly the borrowing started increasing, 96 crore and 103 crore. So immediately you should say why they needed debt, whether the business is not generating cash flow. Go to cash flow statement and see business is generating cash flow for this year, but here it is not generating. Even here it dipped. Why it dipped between 2017 and 18? That is the next why you should ask. Then the next why you should ask is, here 100 rupees they are getting. Why only 37 rupees is getting converted from the profit? Why? So this will give you the clues, right? That something is wrong. Why 70% of profit is Chumantar, why it is not converting to cash flow from operating activities. And this I told you, right? 10 years average, if you see, you get to know kuch to gadbad hai daya, right? Only 2% of the profit is almost converting here. Clear? So something is terribly wrong here. And then you see suddenly they have done the capex. Why they have done so much of capex? Whether their uh, fixed assets were running properly? No, the turnover was decreasing. Then why they did capex? Ask why. Okay, so that is how you will start getting the clues of the puzzles. Then you go to DuPont analysis and see what were other factors, why the margin was dipping, why the debt they needed to take if they are generating the cash flow, right? So all these questions should come automatically. The asset turnover was dipping. Then their suddenly EBIT margin turned negative, why they started making losses. So all these questions should trigger, that why this is happening, what is this other income, why major portion of this is going into other income, whether they are hiding something or not. Then you go to annual report and see, the notes to all these other income, and then you will find the aha moment that, okay, I did not see this. So this is how, and again, I've done this slightly quickly, but this should be the flow and you should be doing the thought process. Let's take one more company. Let's take one more company, Gufic Biosciences. Okay, let's take Gufic Biosciences and do this. And by the way, we keep on doing this often. And if you want to stay connected, I'll also share a Facebook group which we have. So if you also want to participate there, you can just join this VIP group, uh, and you can join there. So it is technofunda.co/Facebook. I'll also share the link in the comment section. So if you want to, do some analysis like this in the future, we can. I do a lot of stuff on the Facebook group also. So you can learn there with me also. So I'll share the link. If you think it's worthwhile, you can join. I'll manually approve it. So it is by invite approval process. So only limited people are allowed there. So we'll approve that once you click on the invitation. So what next we want to do is Gufic Bio, right? So again, let's go to the screener template. Let's go to Gufic Bio. So let's say I'm now going to Gufic. So this again, I'm not tracking this company. It is a pharma company, but let's see how you can do it. Okay, so I'm also doing like a outsider. So I don't know anything about the company. I've never analyzed this company in detail. So what I'll be doing is live in front of all of you. What should be the ideal thought process? So go here, do enable editing, and the first thing you should see here, market cap 900 crores. So that means it is a more like a small cap kind of company. Then PE ratio is 37. Okay, operating margin is 13. So this company probably does something good because the operating margin is slightly more than 12%. Then immediately come to the income statement. 9 years growth good, 3 years growth has gone down. So again, ask why the sales is dipping. The long term growth rate is much higher. Why the near term the growth is lower? Ask why. Go to different sources and analyze what is happening in this company. Then you go to your EBITDA is perfect. So this is probably because the company is having some pass through. So whatever raw material prices are there, they add some fixed margin and then they sell product. That is potentially reason that looks to me, because the sales growth is going down but my EBITDA growth is intact. So that means that business model could be just pass through x plus some margin kind of business, and that we will come to know over here. Okay, so if the sales is going down but the operating margin are increasing, most likely the company is like into the pass through contract kind of fixed rupee term margin kind of business. So that immediately you can know that, okay, the margins are almost increasing over here despite the sales going down. So that is fine, because ultimately my EBITDA is increasing, and that is what as an investor I want. Now go to the profit growth. Profit growth is fantastic. So for last 5-10 years it is growing amazingly well. So something interesting they're doing. Again, you should go into the business model and see uh, what kind of product they have, whether they have competitive advantage, whether they have patent protection, whether they are lowest cost producer in that product. So all those kind of next steps you have to do. There is a full process to it. Then also see this, whether the number of shares has increased. If it is increased, either it could be due to bonus or it could be a genuine equity dilution where promoter is selling or issuing new shares and they are raising capital. That could be a potential negative sign also. Now, this is interesting, so this is what you should again see. The PE re-rating happened till 2018, but then there is a sudden drop. What does this indicate? I told you just before some time. This indicates that potentially market is factoring that future growth might not be that well. And if you go to the TTM profits, market is right. Here it is 22, there it is 23, and here it is TTM is just 24 crores. So this jump which they saw 9 to 16 to 22, it was all factored in over here. And as an investor, we might have thought, oh, I'm paying very high multiple, 50p, 55p, बहुत महंगा share है. But what happened to the price? Just doubled on no time, right? And here it has flattened out. Here it is probably not growing at all much. But here you will think sasta hai, right? So be very very careful with all these things. I have learned hard way after many years of investing, but you have to always think. And if you see the charts, you'll know again that jab sasta ho gaya, it is because the price has fallen drastically and something has happened here. Okay, so it is in a very big downtrend. So you should again see this phase, what happened during 2018 to 20, that it fell so much, there was a downtrend, and also your sales almost dipped in these 2 years. So what happened in those 2 years, that is what you should be focused upon. Then you will also start getting answers over here. The interest coverage ratio is fine. Earnings per share, again it has flattened out here. You should again check this. And then I think nothing much on the income statement. You can go to balance sheet and again see all other things. The debt levels, they are increasing. So then next question should be whether my debt to equity ratio is also increasing. No, it is almost fine, not increasing that much. So that is not an area of concern. The net fixed asset turnover is increasing. Again, ask why this trend is there, what they are doing special, whether they've gone into new product or what they are doing. This should raise alarm in your mind that the average, see again I've kept average over here, that average was 84, 88 kind of numbers. Why it has shooted up to 96, and now why it is 104? Why the receivable days are increasing? Ask question whether they have changed the credit terms, whether the industry itself has become hyper competitive, or they have lost the pricing power. Lot of questions to ask. Then go to inventory turnover, see the similar ratios, okay, and ask why. Then the return on equity is also dipping. Probably that is because the profit is going down. So again, see what is happening. This red area, you should go deeper. Then let's come to cash flow statement. So cash flow statement, again come there and see what's happening there. So here you are saying negative operating cash flow. Again, this is area of concern. You should definitely look why this cash flow is not converting. And overall also it is 77, which is decent, not that bad. But in this 1 or 2 years, there is some concerning areas. So you should check this, why it is happening. Again, it could be genuine reason, but you should check it. And again, one more thing which I put in here is the reinvestment rate. So what is the capex divided by cash flow from operation? That will again give you idea whether companies putting the money back into the business or not. If you see companies like ITC, you will find it different. They are not reinvesting. And then of course you should see the DuPont analysis and cumulative ratio analysis. So shall we take ITC just to see the reinvestment part which I talk about, whether they are doing some reinvestment or not? Just type yes if you want to cover ITC also. Yes, cool. So let's do ITC. I think this is anyways a hot favorite of many people out there. So let's see what is the story of ITC. Again, I'm not closely monitoring this company. I'll be just doing the same kind of exercise. So operating profit margin, this is the first thing which comes into the mind. Okay, that 34% operating profit margin, insane business. ऐसा कौन सा business है भैया? 34% margin देता है. So the answer you all know, right? Sutta business, monopoly, addictive, high margin business, government approvals, lot of things. So that is the reason probably they are having high operating margins. Now, whether the margins are on improving trajectory or not, more or less flat. So probably from last 10 years, they are hovering into 34 to 38% margins. TTM is 34. So they have seen dip in the margin. So that is something you should analyze why that has dipped. Interest coverage ratio, very good, right? Because पैसा छाप रहे हैं, interest कहाँ से होगा? No debt, so no borrowing. again, I'm assuming just from the business model. I have not even seen the balance sheet as of now, but I'm sure if you go to balance sheet, you will find that. Okay, so almost zero debt, right, based on the company market cap. So debt-free company. So that is fine. What is happening to PE ratio? PE ratio is constantly getting compressed, and now it is at probably very low PE. And if you see even the TTM, it is 18 PE. So what comes next to your mind? Probably market is discounting future. Maybe the growth is going down. And this will answer that. The sales growth 9 years was 9%, 3 years 5% only. So they are struggling for the growth. Then ask why. Whether the cigarette consumers are decreasing, whether there is a competition which is coming in, what is happening, why, or they are deliberately decreasing the focus on cigarette business. Again, these numbers will be cumulative numbers. Ideally, you should break it down by segment and see for a deeper insight. So that is on that part. Profit growth decent. Again, very average normal profit growth, nothing very special. Ideally I would get excited if the growth is more than 15-20%, but it is very nominal. Kind of any company in India which is a normal average company, that will grow with this growth rate. So I'm not finding anything exciting here. Then if you think about balance sheet, what is happening? Fixed asset turnover almost in the same range. So average is 2.7, 2.6. It is almost hovering in the same range. Nothing to worry about here. Receivable days very low. Again, sutta business, monopoly kind of business, so they're getting money very fast. So that is also not area of concern. Debt to equity ratio, obviously almost zero debt company, nothing to see here. Return on equity, this is again very, very critical. 2013 36% रिटर्न ऑन इक्विटी. 100 रुपए का बेच रहे हैं, 100 रुपए इन्वेस्ट कर रहे हैं, 36 rupees they were getting. Return on capital employed, it is again with debt and all that what you are generating. Okay, so total capital what you are generating, 52%. Insane level of business, very nice business. But then why it is decreasing? 36% to almost 23% normal average it came, and this is almost hovering there. So has their pricing power gone down? Has their expenses gone up and they are not able to pass to the customer? Has the excise duty gone up and government is just sucking away cash from there? That is the question you should ask. Then see this also, ROCE, same thing. Now still 25% ROE, 32% ROCE, excellent numbers, no doubt about it. Next question you should ask is whether I can open up the branches. Yeah, Raju Bhaiya ke son and grandson are going to do the same business. Okay, so that answer you will get from cash flow statement. So go to cash flow statement, see where they are putting their money. So they are earning say 14,690 rupees, 690 crores. And what is the capex or reinvestment they are doing? Only 3,000 crore. And what is the depreciation of the company? Depreciation is 1,600 crore. So 1,600 crore is just the maintenance capex. If they want to just maintain the same amount of asset, 1,600 crores goes there, and remaining around 1,500 crores they are left with for a new fresh capacity. What is that as a percentage of CFO? Only 10%. So I'm earning 100 rupees and 10 rupees I'm using to put up a new branch. Why? Is there no new opportunity to expand for my Pani Puri business? Ask question whether धंधा saturate हो गया, nobody else is asking for more cigarette, और मैनेजमेंट ही खराब है. वो रामू काका भैया सेट है, भैया अपना तो चल रहा है, बढ़िया गाना सुन रहे हैं एंड धंधा चल रहा है. So I don't want to worry about anything. Is management not aggressive for growth? Is there is lot of competition that is coming in? What is happening, right? Why they are not able to invest the money in the business? That is the question you should ask, because that is where the growth will come, right? Otherwise Ramu Kaka will grow 10%, 12%, then doesn't make sense, right? It needs to grow properly if you want to have good investing returns. Are you with me so far? Just type with you if you are getting me what I'm talking about. Getting me? Superb. So that is how you should look this as a movie. Okay, and this will also give you the idea. Reinvestment percentage 42%, 37, 38, 28, 23, 21. It is going down and down and down. So they are, every year they are finding difficult to get a new reinvestment opportunity. They don't know where to expand. Okay. And then you see the cash flow from operation to PAT, very good conversion. So gafla kuch kar nahi raha hai. They are basically, clean company as such in terms of PAT and CFO, if you look about it. So that ways there is no issue about that. So that is on the this side. And then you see DuPont analysis, you will get an idea. Tax burden, how much is there? Then interest burden almost nil. Margins are decent. Asset turnover is going down, so this is probably something you have to watch for. And equity multiplier is decent. So overall, there is no red flags or issue. It's good, but only thing, the biggest area of concern is two things: growth and the reinvestment of cash flow. Okay, that is what you can analyze from this company. So this is how you can go on, and you can get an idea. And on the top of it, if you do some technical analysis also, it will give you much more insights, and you can tie the dots. Right now the timing is limited, so I'm not covering all those things, but you can stay connected, and a lot of things on those sides also I keep on doing. Yeah, so Pawan is asking, does the capex include both new investment and depreciation? So it is a new capex, but depreciation any which ways it happens, right? So if you have 10 plants and the depreciation of each plant is 10 years, every year basically you are giving away 10% of your asset. So after 10 years you have to buy new. So in a way it is a more like a maintenance capex. The cycle could be different, for 1-2 year you can ignore, and then you can again do new capex. All those things can happen. So Sharad is asking, can we predict right stock price as per fundamental? See, I find it very, very difficult unless it is a bear market. So that is the reason precisely I add price volume action. I also add some of the technical indicators to do my stock analysis precisely for that reason, because fundamental alone will just give you the mirror view कि पीछे क्या हुआ है, आगे की story market will know, right? Most of the times people know, people are smart enough. There are 3 crore people out there, and they know a lot of things which we don't know. Now Hardik Solanki is asking, does promoter holding play important role? Definitely it plays important role. And ideally what I generally prefer is more than 50% of promoter holding. And second important thing is the pledging. Okay, so I prefer pledging not more than 10 to 20%. Ideally no pledging is best. So if promoter holding is high but the pledging is also high, then it is again a area of concern for me. At least that is something which I look very closely. And also the float also plays an important role sometimes in the analysis, because there is a lot of supply that is coming in, and that is where I also look at volume profile in the charts, and try to see what kind of supply it is coming in the company. Clear? Just type clear if you are clear so far. Uh, Amal Shah is asking, what's equity multiplier? So that is basically, see the ratio, it's already given in the Excel. So if you see the equity multiplier, it says total assets by shareholders equity. So it is basically, say Ramu Kaka is opening a Pani Puri shop, and they are basically putting 10,000 rupees in the shop, and 40,000 is borrowing, and now his total asset, the entire thela, is 50,000 rupees worth. So his equity multiplier is 5 times, because whatever asset he has got is 5 times the money he has put in. Very clear? So खुद का पैसा 10 रुपया and asset बनाया 50 rupees का. That is what Vijay Mallya did, right? Lot of aircrafts, everything funded through debt. So that is what it will tell you. If the equity multiplier is very high, you should again be concerned that most of the ROE is coming from other people's money, from borrowing, and it is a dangerous sign again for some of the businesses. Depends on sector, but if it is like really high, you should get definitely concerned. Con call versus investor presentation versus credit trading report. All the three are important based on why you are answering. So why you are asking is most important. Okay, so that is what is very, very important. uh, Subra Rani is asking, please guide how to use scanner with technical analysis. See, so I have done a video on YouTube channel. So you can go to my YouTube channel, and there is a video on technical analysis trading view. Okay, so go to that screener video. In fact, I also have a gift over there, a separate gift which I have given. If you are watching that, so just go to that video. It's called Screening and Advanced Techniques on TradingView. I'll just share the link also, just for the benefit of everyone. Okay, so I'm just sharing the link here, and you can get going. So everybody have got the Facebook group link if you want to join. Have you all got it? Just type got it, or shall I share it again? You can join that Facebook group, and you know on Twitter where to find me. A lot of people follow me on Twitter, so you know my handle Mashrani Vivek. So you know where to find me. I'm also sharing on YouTube. Just in case you want to get in there. Yeah. So is there a way to scan which stocks avoid all the red flags? Yeah. So this is the way, right? So I showed you which all things you have to check. So all these cash flow statements, what is the conversion from PAT to CFO? Uh, you have to basically focus on. Link to download Excel. Yeah. So link to download Excel is technofunda.co/Excel. You'll also find it below this video. Okay. So you'll find it below this video in YouTube if you are watching it from YouTube, and you can download there. It's free, and you can access that. Cool. So I think we are towards the end of this session. Hopefully, you learned a lot in this session. And this was just a special gift on Republic Day for me. And for people who are not able to download the Excel, or they are finding any issue, just write me an email. I'm sharing the email ID. Connect at the rate vivekmashrani.com. Just write me an email. I'll share you the Excel also. Okay. Just in case you are finding it difficult. Again, it will take some time. Ideally, just download from that link itself. Superb. So that's it, guys, from my end. Again, thank you for joining. Thank you for being live. If you are not yet subscribed to my YouTube, just go ahead and do it. I'll be sharing a lot of such stuff in the future also. So just make sure you are there, and get alert whenever I go live next, so that we can stay connected. And enjoy your rest of today, the Tuesday Republic Day holiday. Enjoy your rest of the day. God bless. Thank you for being here, and stay connected. You know where to find me on Twitter. It's Mashrani Vivek is my Twitter handle. I'll also share that just in case you are not yet connected with me on Twitter. Jai Hind, stay safe, and see you in the next session. Bye-bye. Yeah, the recording is already there on YouTube. So this is live on YouTube as we speak. So it's on Zoom, as well as it's on YouTube live as well. So you can just go and see this session live on YouTube later on.